Well, hello everybody, and welcome to today's presentation, How to Trade Strong Chart Patterns, with myself, Ken Calhoun from TradeMastery.com, and my colleague Sasha Evdakov from TradersFly.com. As always, all information is for educational use only.
My main focus in this half hour here that we'll do, and it might run a little shorter in the 20 minutes, I'll just try to keep it very simplified for you, is really looking at trading at all-time highs. And I'll give you the 5 kind of quick bullet point lists. Really when you're trading at all-time highs, my main thing that I'm going to cover with you is just your personal psychology that you're going to go through. We're going to look at kind of either you're going to go with another stock, you can buy your full lot, you can buy a little at a time, you can wait, and then I'll get into probably the last 10 to 15 minutes of showing you how to deal with options. So getting kind of paid to wait. Some people are maybe just new to options or just getting started with options. So we'll keep it kind of basic in that respect, but I'll show you what you can really do and the power behind them, even if you just want to keep it simple. So everybody's at different points. I don't know if you're kind of new, intermediate, or more advanced, but we'll try to break things down so that way you can go ahead and figure out where you are at, and then go ahead and see where you can pick things up with the option side. So you can always fast forward this video later on if you're not watching it live. So looking at the market right now, one of the reasons why I looked at doing it, a topic on this section of looking at all-time highs, is because we really, as a trader, as an investor, you don't know how high a market's going to go. The reality is that most markets continue to inflate with time. They just continue to go up, and that's just due to, inflation overall. Hamburgers used to cost a lot less, from 20 cents to 50 cents back many years ago, to now you can pay for hamburgers for $5, $20, $500, and even $1,000 lobster burgers. So everything with time continues to inflate, just like with companies. Naturally, any company you look at, like a Spotify, they typically will continue to grow with time, unless, of course, there's not enough earnings or revenue. So looking at longer term companies like a McDonald's, you'll see with time they continue to grow. Anything like a Walmart, they typically will continue to grow. That's just the nature of it. So as a trader, you're kind of always scratching your head and you're wondering, well, do I buy it at this point? Is it already too high? When do I get in? Of course, buy low, sell high is kind of the typical approach. If you're shorting, you're going to sell high, buy it back at lower prices. And now with the S&P, as we go into these kind of all-time highs right now, coming and nearing the 3,000 level, you again begin to wonder, well, are we coming into a resistance level? Is it really the right time to get in? Well, I don't want to miss out the move. So all these things psychologically start to play a little role. And humans, we don't like to wait. Patience is not a strong suit for most people. If you go into a grocery store, a lot of people, they don't complain. They complain more so about, why is this checkout person taking so long? Rather than starting maybe a conversation with the person in front or the person in back and having a good time. There's always that frustration. Hey, I have to wait for my food to be ready. It's been 20 or 30 minutes since the waitress has stopped by. So these are all problems that we've trained ourselves. We're a microwave society rather than a crockpot society, and with stocks being no different. So we're moving, and we continue to move into higher prices, and we wonder, well, when is the pullback coming? Is it still going to come? And it tests our patience. So there's a couple things that you can do as a trader, and I'm going to make this list for you right here on screen so you can see it. It's basically, number 1 is you can go with another stock. Number 2, you can buy a full lot, meaning at all-time highs. You can buy a little, or in other words, I call it a nibble. Number 4, you can wait. And number 5 is sell the option premium. So if we go through these are kind of your situational choices. I don't usually use the word options in trading, or I try to avoid it because we talk about option contracts. So these are kind of your choices when it comes to getting into these these stocks and positions at all-time highs. So as you're scanning your list, let's say you have a top list and you're going through maybe an Apple, an Adobe, an Amazon. Some of these are near their all-time highs or approaching there. Like, for example, an Apple is still not at its all-time highs, but like Adobe, it's kind of there. It's near there. So you kind of, well, do I go with Adobe or do I go with something that's an Apple? And these are things you have to play with in your own mental scope. So the first option is, okay, do I skip the stock I'm looking at if you really were interested in Adobe, and do I go to another one like an Apple or maybe a Boeing that sold off a little recently and try to buy it at lower prices? So that's kind of the first choice. The second choice is, do you buy a full lot? And the third choice would be, do you buy a little? So when you've decided already what stock you're going with, well, there's always advantages and disadvantages to going with these situations. So if you buy a full lot, well, buying a full lot, meaning your full position, let's say you normally trade 500 shares. If you buy your full position right here, well, what's the kind of the trade-off? Well, you get more profit because you've bought your full position, but the downside, of course, is there's more risk. If you buy or nibble a little, which basically means, let's say I only then get in 100 shares instead of your 500 shares. Well, in this case, well, you have less profit, but the advantage is you have less risk. So this is kind of a trade-off that you have to decide, well, what am I going to do as a trader? Where am I at on my portfolio? What is more advantageous for me? Oftentimes, I would say if you're brand new and you're not quick at the computer, if you're just getting started, it's good to trade less. I feel like too many traders get in too fast, too quickly, and too large, and that's how they burn an account. So I would say always start smaller, and as you've traded more and more, you can always trade bigger. And what this does is when things pull back, it allows you can average down a little bit, or you can slowly build up your bigger position, your full position. Now, normally you don't want to just keep averaging down as the stock continues to tank, and go lower, just because then you're buying into a bad company. But the thing is if you've only really committed a quarter or a half or a third of your position, it gives you much more flexibility. So for example, if we look at Boeing here, if you went ahead and, already in the past, the stock was, let's say, at near all-time highs. If you've committed just a little bit around this 380 mark, and the stock continued to go higher, you added a little more, So here you might have went 100 shares each time. So now you've gotten 300 shares instead of your full 500. And when that stock dropped down, you're a little bit less worried because you still have kind of 200 shares worth of capital in your reserve. Now, if you're trading smaller, of course, it could be just 10 shares. Don't think of it as, hey, I have to trade 100 shares or 5,000 shares. You could trade a lot smaller. You could trade 5 shares. Everyone's at a different point. The whole concept behind here is to understand the management side of it and the risk side of it. And if you get in your full position, let's just say, right away, of course, there's a huge advantage right here. Let's say I got in my full 500 shares because now I've gotten in it earlier rather than getting it in up at these higher levels, my other 100 shares. You do get in it early, but if things did not work out and this started to roll over, that could be a huge problem. Now, take a look at things like the Humanas these days, right? So imagine you were trading one of these and you were kind of getting in and you're getting into all-time highs and you thought, okay, it's starting to break out over here. And you got in your full 500 shares. All of a sudden, this thing starts to roll over, and you don't have enough capital to start averaging into it because already it's down quite a bit. You've already put your full 100% of the amount of cash you wanted to in that position, and that really becomes a problem. So these are kind of the two main issues I see traders do, is that they get in too big, too fast, and they don't think about what if it goes against them. So if I was to leave you with one piece of advice before we move on to the next section, is always be prepared to think and evaluate what are you going to do when things go against you. So that's the big picture and the big concept you got to think about as a trader. So when you're looking at these things, at trading at all-time highs, you can go with another stock that may give you a little bit of a change up. You can buy your full lot, which allows you to have more profit earlier on, but you're adding in the risk if things go against you. If you nibble, it gives you a little flexibility, but you get a little less profit. So for me, at all-time highs, I think this, buying a little bit, is a little smarter approach. Now, if you're more cautious, depending on your risk tolerance, let's say you don't like going skydiving, maybe you're more trying to protect your retirement, sometimes it's wiser to wait. There's nothing wrong with sitting in cash and on the sidelines. There is absolutely nothing wrong. Looking at Humana here, since we have this example here, if you got into this stock a while back, and you started taking some profits and some shares off with time, and now you start seeing this thing pull back and it's getting into all-time highs and the market is at all-time highs, there's nothing wrong with sitting the rest in cash and just waiting. And when you get these pullbacks, you can slowly start adding back in and nibbling some more. The same thing with Kraft ketchup here. Heinz, right? So, okay, maybe you thought, hey, this thing was going to continue to move higher, but now look at what happened. You never know which stock or company is going to do that. All you're trying to do as a trader and an investor, you're putting your stocks, you're putting money into your stocks and investments, you're getting your dividends, or you're taking money off the table as that trade works in your favor. And of course, reducing your risk from trades that don't work out. So that's the name of the game. But unfortunately, you don't get paid for waiting. So looking for a stock like Kraft, Heinz, and ketchup here, if you're trying to get in it at lower prices, you never know how low it'll go or when you can really pick it up at lower prices or where's the bottom. That's a tough thing to guess. And of course, once the stock starts tumbling, you just kind of would rather wait it out until it maybe creates a rounding bottom, sideways consolidation, or something of that nature. But with the power of options, you can actually do something a little bit different with it. And I'll show you as an example with Humana. Normally, this is great for people who are interested in owning the stock in the future. And if you're brand new to options, this should work out fantastic because you still need the cash and capital to be able to own the stock. So if they assign it to you, because our goal here is we're going to sell insurance premium on the stock. And if they assign it to you at a lower price, you get to own that stock at, let's say, about $200. But if the stock never reaches 200, well, then you get that insurance premium absolutely free. So here's how this kind of works. And it's by the premise of these trading options. So you take a look, and I'll just show you a very quick example. If we go to Humana, this is the Thinkorswim platform, you choose the amount of date. This is the difference with options, is you have the amount of time or dates, right? So this is 29 days till expiration, 36 days, 120 days. Think of option contracts as like coupons. Coupons have an expiration date. They have the amount of discount you're going to get. And with time, if you're going to a baseball game, so if you're going to a baseball game, you can go ahead and sell that ticket, let's say 200 days out, still probably for full price. Once you get into maybe 5 days before the baseball game, it's probably not worth as much because you need to dump it and get rid of it because the game is starting soon. And if already you're a few innings in, then you need to definitely get rid of those tickets. And sometimes they're $5 and just to enter. So this is the thing with options, is the further out in time you go, the more expensive it is. But that also means you as an option trader, or in our case, we're going to be an option seller, we get to make more money in premium. So where do you believe that this stock, let's just take Humana as an example, could be of good value? Looking at it, you could do it based on technicals, you could do it based on percentage of support levels, but let's say somewhere around the 200, 190 could be an interesting spot. Even getting it lower and below this 238 level could be interesting, right? So somewhere around 215, 210, and if it never reaches that, I could still go ahead and collect the premium, but not have to buy the stock. So what you do to be able to do this, I could go 30 days. Am I looking to do this for 30 days? Am I looking to do this for 120 days? Let's say we're going to go for 30 days. And I could go ahead and sell, and this would be selling a single, and it's off my screen here, so we'll just right click here, sell a single right around to 200. So what does this mean when I did this? Well, here you have the call side for those of you that are new, and you have the put side. The put side, don't get too complicated into it right now, but basically calls, if you're normally a buyer, these things will go up. If you're normally a buyer, you're looking for puts or the stock to go down. In our case, we're a seller. So we're looking for the opposite of that, okay? So in our case, we're gonna be selling the puts, and I'll show you a risk profile picture of what that looks like. And if you've never seen one, it looks something like this, okay? So if you wanna look at this, the profit is on the left right here. So here's our zero line. And this is what you make profit. Anything below that is what you lose. And the stock price is on the bottom. So the stock moves either up this way or down this way. If you look at it as a single stock, just to show you an example of what a single stock profit and loss picture looks like, it's going to look something like this. So stock goes up, you make money. As I move the mouse, you can see 100 shares or 500 shares. I'd be profitable, about $8,343. As it moves down, I'd be at a loss, right? These other lines here are 10% up or down. With options, we have an extra line. One line, the green line, is at expiration. The other line, white line, is today's line. So if I was interested in owning that stock at 200, I could sell a single put contract at 200. This is the May contracts, which are 29 days out at expiration, and they expire actually the next day after that. And here, what this tells you is, here's our Greeks. If you've never heard about options, these are the way you manage these option positions. The most important one is kind of your delta, your theta, and your vega. I'm going to concentrate a little bit on your theta right now, which is 8.08. These are 10% up and down, so I'm not going to focus on these. The current line right here, your theta is 808, which means you're making $8.08 every day at this point when that stock does not move. So if I shift the time, this is a prediction of what's going to happen, meaning in theory, if the date continues to move and the stock does not move at all, you can see that theta wiggles and changes with time, and my profit and loss right here also continues to grow. Now that white line will get closer to that green line. So here's what happens is that eventually, if this stock did not move at all, at expiration, I would make $95 on one contract. Now, one contract controls 100 shares. So if this does not work out and the stock lands at 180, I would own that stock at 200. I would own 100 shares for the $200 price, even if it's at 180. That's one of the big downsides to it. The huge upside to it is if the stock actually stays above 200, well, I don't have to own the stock. It doesn't matter if it's 201, it doesn't matter if it's 280, it doesn't matter if it's 290. As long as it's above that 200, that's my contract, that's the legal contract, then I would go ahead and earn $95, okay? And I don't have to own the stock. And I can do this every single month, time and time again. If that stock continues to move higher to 245, I could sell the 210 contracts. So I would just kind of move this to the next month and I would go to the 210. And now I can go ahead and restart the clock and the basics, and it would just continue doing that same process. Now, the closer and tighter you are to the current price, the more that you can make on your premium, because if you look at this one, you could make 150. And that is just because there's more risk, right? The wider you go, the more chance of success, but the less you'll make. The closer and tighter you go, let's say I made this 230, well, I could make $510, but the chance of success is, it has to drop to 230, which is only about $10 away. So it's more risky. So basically, my point here is rather than waiting for a stock to constantly pull back, if a stock's already at all-time highs, sometimes it's nice to go out a little wider right here and collect a little premium. And you can do this for multiple months, and you can get $95 for every single one contract here every couple of days. And every stock is different. This is Humana, and it depends on volatility, the price, many other factors. But here in this case, it just basically, the white line gets closer to the green line. You have to have the cash though. If it goes against you, this is known as a cash secured put. If it goes against you, you have to have enough cash to cover 100 shares of that stock if you're doing one contract. If you're doing 2 or 3 or 4 or 5 contracts, let's say 5 contracts, you have to have enough cash in your bank, in your trading account to cover up to the 500 shares because they will margin you out unless you're doing portfolio margining or some other kinds of things. It's a different story. But in general, this is the way that you would do it, the trade, is that you have to have enough cash. As you get more advanced, and we'll kind of leave it at this, to use less cash if you don't have enough cash, let's say on Humana, you could buy a contract a little further out, 185 as protection. So instead of selling, we're going to be doing a buying. And all that does is reduce your risk, and it caps it, so you need less cash for that. Can you still get assigned with this if it goes against you? Absolutely. But here, you're limiting kind of your max loss to 1485 because you have the other side that protects you. If you need a little more help or hand, or you have questions about this, feel free to take a look at my YouTube channel, or even send in some questions on our website at the Traders Fly website. I'd be happy to go over it with you. But I know if you're just brand new to options, this may be a little more complicated. But I wanted to show you and open the doors for you to show you what's possible for stocks at all-time highs, because when you have things like even a Boeing, I would say is at all-time highs. Look at a Disney here. It just continues to go to all-time highs. Would I want to chase this stock up 10, 15% from there? No. But could I go ahead and try and nibble at 120? Yeah, because how would I do that? I would go ahead and I would type in my Disney, and I would see what option trades are there. Could I go a little further in time? Because Disney moves slow, so there's not a lot of premium to get. Even at 120, you'll only make 26 cents, which means because it's 100 shares, you multiply times 100, it'll only be about $26. I could go further out in time to about 92 days in July, and I could go ahead and do the 120s there. And let's just say we sell a single, or of course, what you could do, depending on the platform you're using, is you could just go ahead and click that and it'll pop it up. I'll analyze the trade because I find pictures are better for most people. And look what I can do with Disney. It's like, hey, if it just continues to move higher, I could just continue to keep putting on these contracts and not buying the stock, and I'm going to be collecting every couple of months about $110. Now, again, I have to have enough cash to cover 100 shares of Disney at the strike price I buy, but I'm making, you say $1.74 on this one per day, which is not a lot, but with options, they expire exponentially, so they go faster and faster at the end. So initially it's $1.74, but later what's going to happen is it's much faster. So as the date gets closer and closer, these things actually decay even quicker, because on an everyday basis, especially if you get to at the money level, you'll see that it's a $3, $3.64, $3.75, $3.80, $3.97, $4.07, $4.12. And that's really what you're trying to do, is with all-time highs, if you're just trading basic stock, you could either go with another stock, you could buy a full lot, which allows you to have more profit, but of course more risk. You could buy a little or nibble, which means maybe a half, a quarter, a third of your position. You make less profit, but then of course you have less risk, which is recommended from my point of view if you're just new and getting started. Of course you could wait, but if you still want to make some money while waiting, you could sell option premiums. But of course, there's some brokerage requirements there, $2,500 limit or so, depending on the broker. And of course, you got to understand what you're doing. But I've shared with you kind of the door and the window of what you're really trying to do, and hopefully it gives you a bigger picture and perspective of the possibilities here of still making money while at all-time highs and picking up that stock at lower prices. It's kind of like bottom fishing for stocks, but still getting paid for it while waiting. So I hope that kind of makes sense. If you have questions, again, feel free to reach out. I'd be happy to answer them, and I'll stick around here till the end of the webinar as well, just to make sure things get answered if anything comes up.
All right. Well, thanks so much, Sasha. Maybe can you show them your website and a call to action for them to learn more from you? You're tradersfly.com, right?
Yeah, absolutely. I'll go ahead and pop it open here for you. Take a look at the Traders Fly website here. That's the main website I post. We're getting it reworked here soon as well. You can take a look at some of the books that I have as well, charting books for practice if you like. There's a lot of free videos. If you're interested in options, we have some courses there. So take a look at some of the courses, which will point you to my sister website at Rise to Learn. And there's plenty of option trading courses if this is what you're interested in learning more about, and some that are in production. So take a look at it there, and if you have a question, just reach out on any of these bottom areas on a live chat, and either me or one of my guys, teammates, will help you out, and we'll make sure that your question is answered as quick as possible. Not always immediately, but as soon as I can. So feel free to also submit a voice question if you have one. Right here, you can just go ahead and record one, and we'll put you on the show, and we can even do a video on your voice question, because I know sometimes it's difficult to write in what you're asking with a subject like this. So submit one by voice, and we'll go ahead and answer it directly.
All right. Well, good stuff. That's very intelligent, too. I highly recommend Sasha Evdakov. He's a young guy, but he's the only young person I work with or recommend in the entire internet out there. I've seen, and it's true, because most of the guys out there making all these phony, make thousands of dollars trading $2 stocks and all this foolishness. And unlike that, Sasha Evdakov takes the high road. He's extremely intelligent. For any of my colleagues out there watching this YouTube video or watching this live here, I do recommend Sasha as a guy to work with. He's got my thumbs up. He impressed me and continues to impress me. Very intelligent, as you can tell, and his YouTube channel is extremely popular, and it's a pleasure having you here. So thanks, Sasha. Appreciate it.
Well, thank you for letting me be a part of the community and speaking with you. It's nice to have the kudos from someone who's been around 20 plus years in this kind of industry. So definitely appreciate it. I'm happy to have gotten to know you over the last year or so.
Yeah, appreciate it, man. You're one of the good people worth following and learning from. So you're one of the smart guys. So you're one of the smart, honest guys, which is few and far between out there in this industry. So Sasha Evdakov has my thumbs up, and thanks for being here. Appreciate it, man.
Absolutely.
All right, well, let's go on. Those of you familiar with me, I've been around since the dawn of time, so I trade a lot. I was trading this guy on the bounce, JMII. I got stopped out a little bit early, though. I was only doing a small share trade. Let's see. Putting this up. I'm a day trader, is what I do. So I only bought 50 shares because the range of 34.14. I got sold at 34.23 because I was using a real tight stop. One thing I completely agree with Sasha's point is that these are like all my trades from today alone. Wins, stops, and draws. I'm very transparent with my actual real trades I do. So I'm very active as a trader. One of the things that you want to do as a trader is, like Sasha said, make sure that I like nibbles. I like that phrase. That's a good phrase. Sometimes you'll be directionally correct in a trade, as I was, but you get stopped out if you use super tight stops like I do. I still made a little bit of profit. One of the things that I wanted to focus on today is the importance of trading ranges. This is a 2-day, 1-minute candlestick chart. Let me ask before I get started here, how many of you are day traders? How many of you are swing traders? How many of you do some of both? And I'll tailor my presentation live to the needs of the audience. If you're all swing traders, you probably don't want to look at live day trading charts, and vice versa. So this is audience participation portion of today's presentation. Type in the word day, swing, or both if you would. I nailed UXIN. I was in from 3.25 today, and then I bought again at 340, and I'm hopefully still long and right in the position, so it's starting to work out. We've got both. Okay, well, I'll cover both day and swing charts. We're going to start off with day trading because I'm day trading, but I'm live in a lot of positions right now. One of the first things you want to do as a day trader or swing trader is make sure that you're focusing on wide range instruments. Range is more important. Remember I said this. The most important thing is small stops, strong charts, re-entry, scaling and position sizing. Just like Sasha said too, and I completely agree with that. You don't want to go in like 3,000 shares like some of these moron kids on YouTube say, I have 5,000 shares. Yeah. Well, your upfront risk is way too high. I like to scale in 100 or 200 shares at the most at a time. That way, when you're right, you're right. And when you're wrong, it doesn't cost you much. I'm the master of $20 stops. My risk is absolutely tiny. For example, let's take a look at TVIX, my favorite instrument to day trade. I was trading the pivot here off 215, selling at 2072. Then I tried to buy a bounce here and got stopped out. Trying to buy again here, and we'll see if it keeps bouncing. But when you're trading something that's volatile, you want to make sure that you use relatively tight stops. So let's use a real trade example to illustrate what I'm talking about. I think the order pair was, I use one triggers the other order pairs to manage risk carefully. So where was the fill here? I want to show you the importance. If you learn nothing else from me in this demonstration, it is importance of small stops. Okay, so I bought 200 shares at 20.05. And that simultaneously initiated a sell stop trailing order with about 20-cent trailing stop. So I got filled at 20.05 on 200 shares, and 25B, I got stopped out at 19.97. So that's an 8-cent stop, and I stopped out of 150 out of the 200. So an 8-cent stop times 150 is, I don't know, do the math, about $14. So under $20 to be wrong with a 200 share position. That's the secret to my success as a trader, is I trade frequently. As a colleague of mine, Tom Sosnov, would say, trade small, trade often. I completely agree with that. I say trade wide, not deep. So I'll play a number of different instruments that have relatively good risk management and good volatility. So for example, I correctly traded the bounce in LabVIEW today. Okay, I also correctly traded LabD on the breakout. They trade exactly opposite. They're triple leveraged biotech ETFs. This is the bear, the down one, and the bullish one is LabVIEW. Now, I don't have time to cover arbitrage trading, but that's one thing that I'll do if I go, for example, if I go long in TVIX, I'll also put in at the first sign of a pivot a long trade in the opposite LabVIEW because they have exact pivot opposites. Okay, so if you're doing active trading, look for those kind of correlations or those kind of relationships. Now, when you're looking for good, strong pivots, if you're looking for, and I'm an expert breakout trader, I did correctly trade the pivot in this. The most important thing you look for on a chart is not anything over here. It is this. The math, and any good professional trader will tell you this, the math is so much more important than the chart patterns. The same chart pattern, if the range was, say, 50 to 49, if here is 50 and this is 49, I would not take a pivot long because the profit potential isn't there. It's really important that you get that right, is you have to understand that wide range charts with high volume, at least 15, 20,000 shares for intraday, and good volatility make for good trade setups. You don't want to trade something like, I don't know, for life I've always picked on AT&T, so let's see if it's the same. See, that would be a horrible, crappy, awful, you'll never make money trading that kind of chart. It's AT&T though, it's famous. Yeah, and it's famously horrible for trading. Give me something like this. Clean, tight, wide range breakouts. I'm a foremost expert in breakout trading. I've done as much as 4.9 million in a single year worth of trades. I know how to trade. Even though today I'm getting like death with 1,000 cuts in some of these guys, but others are working out. So, when you're putting together a rack of trades, like here, I bought 2028, I sold 2036, so a small win. You're in and out. And as a trader, you want to not be that trader that over leverages. I know Sasha alluded to this too, and I completely agree. You know, if you're an options trader, for example, you know, 2 or 4 or maybe 6 contracts at a time would be more than enough. And if you're a newer options trader, maybe just a couple of contracts. You don't want to be out there swinging for the fences with huge trades. It's much smarter. That's a Zoom IPO today. First thing you want to do is look at the chart and say, hey, is this going to make me money? The answer to this would be no. I'd be much more likely, even as an expert, to get stopped out trading something horrible like this. If I were to take a shot, not a trading recommendation, I'd buy 63.40 if it got over 63.40. But that's a horrible chart to trade compared to something like this that's much more clean and in focus. Avoiding false breakouts is another thing that takes a lot of years to learn. Oftentimes you'll get a fake out that'll run up right on the opening bell and then crash and burn. Okay, it's seldom worth trying to buy a pivot in today's markets, at least, unless it's a huge point range sold off chart. Like this guy, TIGR. I've got an order to buy this if it bounces because the range, again, 23 to 16, that's a 7-point range. So 7 points of range, if it does a mean reversion, oftentimes you'll get a short squeeze into the close, and if it pops to 18 or something, that would be a good intraday trade setup. You know, similarly, if something like TVIX gets a buy, oftentimes TVIX gets a sharp move up and down into the close. Something like that would make sense. Here's a quick tip for you, something that I think can help you become better as a trader. It certainly helped me over the years. Mark out visually, and again, there's no guarantee it'll do what you say it does, of course. That would be too easy. Silly rabbit tricks are for kids, but mark out the anticipated long and short price action in that particular chart to see if you can see how close you get. It's kind of like a video game in trading. You're trying to figure out the price. You know, if you were going to take a shot, where would make sense for this? You know, where would be the next trade for this? I've currently got 150 buy stop order in at 2017. Yeah, not a trade recommendation, but so I'm a real trader. I like to show you guys my real trade. So I got 150. It's not that much. It's kind of light. Normally I trade a couple 300, but I got 150 share buy stop order at 20.17. Another quick tip to avoid the market maker shenanigans. Back when I used to do live seminars in Las Vegas at the MGM Grand and in Denver and California and New York and everything, I'd often get market makers, and they speak a very different language than retail traders. Retail traders are kind of like, you guys trade choppy charts with too large leverage and with too large stops, and you get killed. Professional trading is in and out, like what you see here. I mean, I got 28 trading decisions today alone, right? 28 pairs of trades. Anyway, small size. You don't see me doing 1,000 shares at a time on any of this stuff, because I like to protect my downside. A great analogy is in martial arts. For those of you who are fellow martial artists or fans of the genre, much to my chagrin, you spend your first couple years learning not how to do these great Jackie Chan flying roundhouse kicks and whoosh-ah, whoosh. No, you spend your first couple of years learning how to fall without getting hurt and how to block without getting your butt kicked. Okay, as a trader, day or swing trader, you need to spend your first few years learning how to use tight stops and manage your risk effectively. That's tight stops with strong charts is rule number 1. Make sure that you're trading charts with nice clean patterns like this guy or this guy. Let me ask a quick audience participation question. If you're swing trading this guy long, or I'm sorry, day trading this guy long right now, where would you put a trailing stop? Let's say, I have to check how many shares I'm in right now. You always use trailing stops, by the way. You never ever use mental stops. That's for the bad traders. Where would you, looks like I got sold out. Okay, so I took a profit. I'm not in this thing anymore. But if I were still long, if you're setting a hard stop, where would you guys trail a hard stop on, say, 200 shares in this? Type in an answer. And I'm not going to say anything bad. There's no right or wrong answers. I mean, actually, that's not true. There's a lot of wrong answers. There's a few right answers. But I'll be supportive and helpful either way you cut it. Where would you trail a stop, guys? Go ahead and type in an answer. All right, TJ. Hey, TJ, how you doing, man? High volume Tim defined as 1 million shares plus a day for swing trades. Anything I swing trade's better got 1 million shares plus on a daily, or for intraday trading, at least 15,000 shares. 1500, 15,000 shares for liquidity. That way you avoid the pump and dump schemes that some of these guys do in their chat rooms, where they try and tell people to trade a thinly traded instrument that, unbeknownst to their victims in the room, they've already bought, thousands of shares, and they tell everyone to buy it now, and then they sell to them on the way up. That's called pump and dump, and it's illegal. The countermeasure is lots of volume. So the correct answer on this would be somewhere under 340, would be the very, very maximum stop loss you would take as a professional trader. 338 would be where I'd set it. If I were long, say 200 now, 338 would be the price that proves it wrong. Use incremental nickels and dimes, especially on these cheap charts. So every 10 cents is a battle between buyers and sellers. When you're using the tape, I wrote the industry's first tape reading article nearly 20 years ago and did a seminar on the topic. I feel so freaking old. I mean, I'm not. I am, I guess. I'm 55, but I feel like I'm 25. But anyway, in tape reading, what you're looking for is the ratio of trades going off at the ask, which is bullish, versus the bid. And in this particular tape, I've configured it to show trades going off at the ask in green. So it's a good momentum indicator. What you do not want to use, and this is my final tip here on intraday, but I'll switch over to swing trading in a second here, but let's see. What you do not want is the classic tape that has way too much information. TMI. A classic tape looks like what you see in the left. This is next to useless. I mean, I don't know about you guys, but which of these can you see the price in easier? The price is the main, that's the ace of the deck, and volume is the king, right? To use a poker analogy, I used to play tournament poker in Vegas back in the day. I won my first tournament 7 years ago. It's great to be the guy at the end of the tournament with all the chips in front of you. But anyway, this kind of classic tape, my point is largely not very valuable because it's got way too much information. It's confusing, as a trader. All that you care about is the price and the volume. And if I had nothing else, all I'd care about would be the price. So you watch this column like a hawk, and I use this in every single trade I'm in. I'm looking at the price to see where current price action's at. Secondarily, I look at the size to see if there's block trades, which tell me things about iceberg or dark pools. And I'm looking to see if we have trades go off with, 500, 1,000, 1,500, something over 300 or 400 shares at a time that tells me there's something going on with the market maker or other market participant trying to trade large size. So that's kind of a quick crash course in intraday trading. But these are the watch lists that my live room members got. These are the charts, both sold down ones for potential pivots that are all in red, which I got a piece of on this guy at least, JMIA. May still be good for more later today, so you may want to follow it over 36, right? Things like this that have gapped up and sold down to support. My favorite pivot pattern. You can take this to the bank. Most of the time, or a lot of the time, is something that sells down to the previous day's high after gap up, sells down to the previous day's high and bounces. So if this guy bounces back over 670 into the close, exit target would be right under the whole number under 695, and that would be a good round trip, to take for that particular position. So that's something to take a look at. Hey Tim, how you doing, man? Yeah, a gap is big enough for a truck to pass through. Those are the best kind. This isn't that though. This is kind of a minor gap, but oftentimes the pivot plays, it gaps up, it sells down to previous day's high, which is why I use a 2-day chart, amongst other reasons, to look at the open range breakout volume compared to current day's volume, compared to where the OHLC, the open high low closes, and other things that we're looking for, intelligently. But see, this is a good watch list of instruments worth taking a shot at because of their volatility, not just because of the nice looking breakout pattern, right? All right, let's switch over to swing trades. I'm using the classic e-signal, but I know I need to probably switch to the the more modern version, but I like this one. Okay, when you're looking, for example, for small cap stocks, this is a 90-day chart. These are my small cap scans advisory service picks for the week. Look at the range of this, right? If you're swing trading, you want something, like I say, the rightmost side of the chart is the most important thing to look at. The breakout's all well and fine, and that's nice, but the range is what qualifies it, along with volume, for consideration for, is it worth trading in the first place? The first place I look for the answer to that is the rightmost side of the chart to see if there is, in fact, enough range and volatility to make it worth my while. Always be on the lookout for reversal candle patterns, like a bearish engulfing. Or in the previous chart for GoPro, we had a shooting star up here. So that tells you not to buy within that range. You wait instead for a breakout. And in this one, I think the long trigger I set for my members is somewhere right over 7, like 720 or something. In the meantime, you stay clear. Don't overtrade too soon. Make sure you're trading charts that have directional volatility that makes sense and breaks out above previous resistance areas. Oftentimes you can see, for example, a shooting star here that confirms bearish overhead resistance at the 200 SMA. I like the fact that this chart, PDS, has finally taken out new highs today, and it's above the 200 simple moving average line. Another quick, for those of you who like these kind of patterns, I don't know if this would be a silver cross or not, but a 50 SMA crossing above the 100 SMA, that generates a long signal, and a good trade round trip is between the kind of the life cycle, the kind of like the highway of gold or whatever, between 100 SMA and the 200 SMA. That's a pivot play, and then you tighten up a trailing stop as it gets close to the 200 SMA, then rebuy if it takes out new highs. If you're looking at higher priced instruments, let's take a look. Let's see if I can find my swing scans picks for you guys here. It's in here somewhere. There we go. This is one of my swing scans picks that, congratulations if you're a swing scans member, MRVL. This is a pick that my members got on Saturday when I did my webinar a few days ago. Look at the range. That's more important. As exciting as this chart pattern is, it's kind of like this is the surface. In Japan, we'd say the tatame and the hone. The surface is what you see in or like Victorian English ideals. This is the polite society surface. The seedy underbelly of what really goes on is what's important to a trader is the range. So this is the dressing. This is the window dressing in the chart. The breakout pattern that I correctly identified for my members is all well and fine. But again, if this was a range where this was 25 and say this was only 24 or something, with the 1 point range, it would be orders of magnitude less interesting to me as a professional trader. I'm looking for charts that I can make money with. You might ask yourself, how do you set your targets, your exit targets for these kind of charts? I'm glad you asked. I usually use 50% of the 90-day chart. So support on this guy is around 17, resistance at 25. That's an 8-point range. So exit target would be half of 8 is 4, which would push us up at 29. So the best case exit target for this swing trade, say if you're to buy somewhere over 25.5, would be an exit target near 29, or at least that's where I would be tightening in a trailing stop. You have to be keenly aware of the numbers and the metrics. The math, the volatility threshold, kind of like the options equivalent for volatility. You're looking at directional volatility as being more important. See, Windows asking what broker. I like interactive brokers. I'm currently trading my Fidelity SEP, and its commissions are killing me. I negotiated a slightly lower rate, but I like interactive brokers for day trading. Pretty much any major brokers like Ameritrade, or I've got accounts with Ameritrade or Fidelity, are fine for swing trades. Day trading commissions are really important. Swing trading, not so much. But do make sure you're using a major reputable broker that has good reputation and all that. Don't use some shady overseas Bahamas broker or some crap like that. You want to be safe, right? What do you notice about this chart? Overhead resistance is the shooting star high. Consolidation is here, and it's starting to take out new highs. Now, I like to buy over whole numbers. So somewhere over, say, buy 20 or 30 cents. So 41, again, not a trade recommendation, but this guy, ENTG, I'm sorry, 41.3 or so would make sense for breakout continuation play. But again, what qualifies this chart is the range. 28 to 40, 12 points of range. Exit target would be therefore 6 points above. A trigger over 41 would yield 47, right? 6 plus 41 yields 47. It's true, I used to be a corporate statistician for the Ford Motor Company, and I'm a nationally certified quality engineer and formerly a Malcolm Baldrige quality examiner. So I've got a lot of expertise in quantitative and a couple of degrees to go along with it. And that really helped me become a better trader because I'm all about the numbers. And that's really, the visuals of the chart pattern are interesting to look at, but the sophistication that you need to get at is more, well, like the kind of stuff Sasha was talking about too. 500 shares versus 100 shares. I will 100% of the time do the 100 share option. I always, I take nibbles, I take small bites, I re-enter when I'm wrong. I don't worry about it. That's the single best thing you can do, by the way, to build your trading confidence, is trade small size, like 20 shares. No, you're not going to make $1,000 trading 20 shares, but you're not hopefully going to lose $1,000 either, right? So 20 or 50 or 100 shares at a time is fine. It's my position that people swing trading with less than 10 years experience should never, ever, ever put on, or day trading for that matter, with less than 10 years experience should never trade more than 100 shares at a time. That should be your maximum, and you should never have stop losses for swing trades. My pain point's around $300 for stop losses on swing trades, and that's, by the way, much bigger than my pain tolerance, which is about $50 maximum on day trade. So really tight stops are what separates out successful from unsuccessful traders. You re-enter, you add to your winners, you scale in. You trade charts that go a little something like this that actually makes sense. Now, personally, I don't trade things over $50 or $60 a share because I trade so much and I trade so many different instruments. I would rather swing trade the basket of 5 rather than try and do 1,000 shares at just one chart. So that's a good point. Question from Tim: how to be a scan for stocks to day trade? I just look at the percent change and then I sort it by volume. So now you do that in my Fidelity Active Trader workstation. You can find similar sorts on any major brokerage account, but those are the kind of things you're looking for. There's a couple of ETFs. J and K looks healthy. Oil continues to be strong. I like to trade UWT as my favorite oil crude instrument to trade. Right? I've been calling it long since 1050, even back in earlier than this chart shows, but always look at the 90-day and look at your 1-year chart and put it in perspective. I've been calling it long from 1050 for my members. I feel like it's kind of chasing here, but it may well recover 38 or 40. It's not to say it's not. So as long as it keeps going up, the trend is your friend. Higher highs, higher lows. UWT is this chart, and that is a crude oil ETF that continues to move up. What I don't like about this chart is the volume is divergent, and that's probably kind of a last tip to bring up. When you're looking at breakouts, you want the price to be in a 45-degree angle breakout, and you want your volume, which a lot of times I know it's easy to forget. I sometimes forget myself, but double check your volume. And if the volume is in a decline like it is here, that doesn't support a breakout continuation. Now, I'll still trade it because I'm a trader. It's what I do. But I'll trade light share size if I don't have volume support. If you have a configuration where you have price going up and volume going sideways, or even worse, going down, you've got volume divergence to price. That means the buyers are running out of steam. So you're going to be smaller share size. You may still want to trade it in case they come back, but it's better to just focus your energy simply on charts that have increasing volume at the time that you've got increasing price. So for example, MRVL, which I just showed you a minute ago here, kind of zoom in here. Do you see how the volume picked up in kind of a volume crescendo here before price broke out? Volume accompanied price, and that's why it had such good strength, directional volatility from 20 to 25. So you've got increase in volume, all these nice big high volume bars in combination with an increase in price. And that supports the fact that it's a good trade decision. So make sure that you're looking for those things. If like me, you often get stopped out with false breakouts, I still take stops every single day. I just showed you a bunch of them. And wins. You want to play the field and make sure that you're looking at these series of small edges, like strong breakouts that continue on up, charts that have direction and that have both momentum and trend and are able to continue up for you in your favor. So anyway, I think I'm about out of time here. Let me show you guys my website, but I wanted to thank all of you for being here. Does everyone see why this kind of chart makes sense to trade? It's got volume and volatility and directional strength. Now, last quick tip, and this is true for day and swing trades, is it's always best to wait till after a small pullback following a sharp move up before you put on a trade, because oftentimes you'll see, oftentimes if you chase, you'll get stopped out because it'll run up, you get long, and then it pulls back. What you want is kind of a bullish flag or a small. Now, I don't buy pullbacks. I never buy pullbacks, or very rarely unless they're big. What you want is a slight pullback like that. And the reason is this is the test of the selling pressure. You want the sellers to test it, and then the bears to come in and take the swipe, or profit takers who are long. You want that to be evident, and then it be overcome by a new wave of buyers, and you get in above the previous high. So that's how you trade breakouts smartly. And that's true for day and swing trades. The times where you get stopped out is, if you're day or swing trading, something spiking straight up and you chase it and you happen to buy the exact top, which much to my chagrin, 20 years later, I still not frequently now, but occasionally I'll still get stopped out by buying a top, and that's because something runs up without a pullback before I get in. So that configuration is one thing to help you avoid false breakouts. So anyway, thanks so much for being here. And no, Akira, I don't trade. That's a great name, Akira, too. My wife's from Kobe, so I'm all into the culture. But no, I don't trade the FANG stocks because the price, you can't get this kind of a percentage return on Facebook, Apple, Netflix, Google, or whatnot. So good point. Well, thanks everyone, and thanks Sasha for sticking around. I appreciate it, man. And
thank you so much. Thanks for everybody who joined, especially on a weekday on the afternoon.
Yeah, we'll get this up to the YouTube channel at Trading Television, and I'll see you guys on the other side. So I'm Ken Calhoun from Day Trading University, or Trade Mastery is my main site now, and be sure to join Sasha Evdakov too at tradersfly.com. Both of us, we're hopefully you found this valuable and worth learning from. So we're both honest, hardworking people that know our stuff. So hopefully that helps separate us from a lot of the people you may have seen out there, and hopefully we can be a help to you in your trading success. So thanks so much for being here, and thanks Sasha. See you next time, and thanks traders. See you guys next time.
Absolutely. Take care.